Maybe you just received an inheritance, or you sold your business that you worked in for 30 years, or you won a settlement or cashed out equity. Whatever the source, here's one rule to remember when you receive a windfall. Don't rush into the market. A windfall can be a once-in-a-lifetime opportunity, or a slow-motion mistake if you invest emotionally, ignore tax implications, or try to chase performance too quickly. In this video, I'll walk you through how to invest a lump sum strategically, including how to think about dollar cost averaging, when lump sum investing actually does make sense, the emotional traps to avoid, and key tax considerations that often get overlooked. And before we dive in, my name's Ryan Knoll. I'm a certified financial planner and founder of Navil Partners, where we help clients nationwide make smart money decisions. And few decisions are more important than how you handle a windfall. Let's jump into the video. The first thing you should do after receiving a windfall is not to move too quickly. When you come into a large sum of money, especially if it's from an emotional event like a death or a divorce or a business sale, your first instinct might be to put it to work. But that instinct, it can cost you. A windfall often creates a false sense of urgency. Suddenly you feel like every day you don't invest is a day that you're losing money. But that mindset leads to rushed decisions, especially when the market is volatile. Instead, you need to take a moment to pause. Park that money in a high-yield savings account or a short-term treasury mutual fund and develop a strategy. And if you don't know what that strategy looks like after you set up your savings account, well, go talk to a financial planner who can just walk you through your options. This isn't someone who's going to push product down your throat or have you invest in their default model, just someone who can educate you on what exactly you should be thinking about as you navigate this decision. You only get one chance to make the first move with this money. You don't need to hit a home run, you just need to avoid preventable mistakes. Now that money's sitting in a high-yield savings account or treasury bills that are very short-term, you need to understand where this money came from originally. Before you invest a dime, you need to understand what type of money you actually receive, because not all windfalls are created equal. Here are a few common examples. If you received it via an inheritance, and it was in a taxable brokerage account that held a bunch of different stocks and ETF positions, you likely received a step up in cost basis on the day you received that inheritance, which means there's not a whole lot in the way of tax implications. But if you receive that money in a traditional IRA or a 401k, every dollar you pull out of that account moving forward is going to be taxable income. Or maybe you received it from a business sale. You might owe capital gains from that sale of the business, depending on how that sale was structured. You might have also sold it via installment sale, an earnout, or an asset versus stock sale, which all carry different tax implications. And if you received it because of a legal settlement or a lottery, these can involve complex income or lump sum tax treatment and may even trigger alternative minimum tax or impact ACA subsidies and Medicare premiums. The point here is before you talk about investing, you need to understand the tax status of the money, because taxes can erode a big chunk of your return if you don't plan for them. Next, you need to take stock of where you currently are. At this point, where were you before you received the money? Take that inheritance or that business sale and throw it out the window for now. What does your financial picture look like? Is your emergency fund topped off? Do you have debt, specifically high interest rate debt that you're paying off every month? Are you behind on retirement or maybe your kid's college plan? Is your employment stable? These are all important considerations, and it's very important to build a solid foundation first and foremost. Using a portion of the funds to top off your emergency fund will give you peace of mind if you lose your job. Paying off debt can help with cash flow because less money is going out the door every month. Analyzing your retirement projections and college funds will help you use the money to get back on track for those goals if you've fallen off course. Pretend the money doesn't exist, and if you find any holes as you go through your plan, we'll use the funds to plug those holes first. Once everything is in good order, then you can think about how you want to invest the remainder. After you've taken stock of where you're at and the money's in your control, the next thing to decide is what to do with the remainder after you've plugged up any holes that were in your financial plan prior to receiving the money. Do you invest it all at once, or do you spread it out over time? Let's take a look at both options. Option one is lump sum investing, and statistically, investing the full amount upfront tends to outperform dollar cost average over time because the market goes up more often than it goes down. Something like 70% of the time, investing as a lump sum will beat dollar cost averaging over time. But that doesn't mean it's always right, because we're not just managing returns, we're also managing behavior and emotions. If you invest $1 million today and the market drops 20% tomorrow, what will you do? Will you stick with the plan, or will the fear cause you to sell? Lump sum investing works best if you have a strong plan, a long time horizon, and emotional discipline. Oftentimes, the best thing you can do is invest a large sum of money is not to look at it for a while. That strips out the emotions and decreases the anxiety of seeing the money going up and down based off of what the market's doing on a daily basis. Quarterly check-ins are probably fine. Daily check-ins, those will drive you crazy. Now, the second way you can invest a lump sum is through dollar cost averaging. So let's say you inherited $600,000. Now, dollar cost averaging would say you take a specified period of time, like 6 months or 12 months, and invest it proportionally over that time. So if you had $600,000 and you invested it over 6 months, you would put in $100,000 each month until it's fully invested. If you did it over 12 months, you would put in $50,000 a month until it's fully invested. And this can be helpful if you're nervous about the current market levels, if the windfall feels emotionally charged because of how you received it, and you want to stay engaged and adjust your comfort level over time. While it may result in slightly lower returns over the long term, the peace of mind and behavioral guardrails it provides can more than make up for that. My advice, if you're confident and detached from the source of money, do the lump sum. If you're nervous, overwhelmed, or new to investing, you probably want to do the dollar cost averaging. But the most important thing is to come up with a plan and stick with it. That's what my most successful clients do, regardless of how they got their money. The fifth step now is you want to match your investment to your goals. And in the third step, we took stock of your current picture and what that windfall could fortify and enhance within your plan. Things like funding your retirement, buying a second property, helping your kids, supporting your lifestyle, or just building long-term wealth. Once you have that clarity, now you need to align time horizon, risk tolerance, and tax strategy accordingly. For example, money needed in 1 to 3 years should not all be in the market. Money needed in 10 plus years can take more risk. Taxable accounts should hold tax-efficient investments like ETFs and municipal bonds, and your Roth account should hold your most aggressive positions. Don't fall into the trap of blindly investing the entire windfall into a one-size-fits-all moderate portfolio. Let your goals dictate asset allocation, not your advisor's default model. At this point, we need to remember that money is emotional, especially when it comes suddenly. A business sale can feel like you're cashing on your life's work. An inheritance can carry guilt or grief. A settlement can feel more like a burden than a gift. That emotional weight can sometimes lead to common mistakes, such as making overly conservative investment decisions out of fear or overcompensating with aggressive choices to make it grow, delaying action entirely and letting the money sit idle, treating the money as separate and not integrating it into your full financial plan. So here's what I tell my clients. A windfall is your money. It deserves the same thoughtful, intentional planning as the rest of your assets, maybe even more. This is why having a financial planner or a tax advisor in the room to help you make these decisions can make a big difference. You may need a calm second voice to help you separate emotion from execution, especially if you're having trouble doing it on your own. Now that we have the emotions in check, let's talk a little bit about something you may not have thought about before, estate planning. If your net worth changed significantly because of this windfall, it's time to revisit things like your will and beneficiary designations, the trust structure you have, whether you have a revocable or irrevocable trust, powers of attorney and healthcare directives, life insurance and long-term care planning, and charitable giving strategies. It's also a great time to consider starting gifting strategies if that aligns with your values, whether that's to your kids, grandkids, or a donor-advised fund. A lump sum doesn't just impact your future, it may also shape your legacy, and your legacy can be cut by nearly 40% through federal estate taxes over the government's threshold if you don't plan appropriately now. So let's wrap this up with some final thoughts. The financial windfall is a rare opportunity. Handled well can dramatically improve your long-term freedom, security, and impact. But it's not about investing it fast, it's about doing it intelligently. So let's recap. When you first receive the money, pause and assess the full picture before you do anything. Understand where the funds have come from, how they'll be taxed, and how they can help fortify any holes within your current plan before you receive the money. And then choose what to do with the rest, whether it's a lump sum or a dollar cost averaging over time. You want to match that investment with your goals and time horizon. And then finally, you want to plan ahead for taxes, emotions, and your estate. At NavWealth Partners, this is exactly where we help clients navigate. We blend strategy, tax planning, and behavioral guidance to protect and grow what you've worked or inherited so hard to build. Thank you so much for watching, and I'll see you in the next video.